There we go. Hi, everyone. Thank you for joining us for Corporate Insurance Strategies 1. It's the first of a series, obviously. So we have number 2, Corporate Insurance Strategies 2, coming Tuesday, March 11th, where we'll be covering more corporate insurance strategies. But this one is going to be focusing on the capital dividend account, which is very important to understand sort of how capital flows at death with an insurance policy that is held corporately. And something important to understand when you are talking about all the different insurance strategies that can be done corporately. We'll also be going through funding buy-sell agreements, which I think is an underserved sort of part of the marketplace where a lot of advisors don't really understand kind of the value they could be delivering to their clients and sort of what help they can do for their corporate clients to help them with their shareholders agreements and funding their buy sell. So I think this will be a very good webinar. And for those that are trying to learn more and break into the large case market, often you will be working with business owners and corporations, and it's very important to understand some of the tax nuances, some of the opportunities and challenges, and that's what we're going to be covering in this and some of the future webinars. I'm joined today by Michael and Weston, the large case team, and they are available to you if you need help with any cases, strategies you're looking at. Clients, if you want to reach out to them and discuss an opportunity, they're happy to take a call or an email, schedule a meeting. But we'll start off with Michael covering the capital dividend account.
Perfect. Thanks, Corey. So my preface would be anybody who either wants to get into the business owner market or already is, the CDA, the capital dividend account, is absolutely something you have to understand and know what it is. It will not only help in your planning for your clients, but if you ever speak to an accountant or lawyer, it's going to step you up as far as them taking you credible and serious with your knowledge base. So it's something you absolutely have to know. I want to start off with, so this is the CDA. This is the definition from the Income Tax Act. So certain dividends called capital dividends may be paid tax-free by private corporations to their Canadian resident shareholders. So I do like to show my clients this, and of course the accountants should know this, but it literally says in the Income Tax Act that these dividends are tax-free. Now, secondly, this is further from the Income Tax Act. It means that no part of the dividend is included in computing the shareholder's income. So you really want to highlight really how tax efficient this is, but then you want to follow it up with some different kind of concepts and ways to explain it, because 9 out of 10 business owners don't know what a CDA is. They don't know they have one, and they definitely don't know how it works. So it's up to us to explain how insurance can kind of be integral in that. So there's a few different ways a corporation can get a credit to their CDA. And the first two are common. This is a bit of a shortened explanation, but it's essentially the non-taxable portion of capital gains. It's also capital dividends received from other corporations. But the third point is most applicable to anyone selling life insurance that's corporately owned. So when a private corporation receives life insurance proceeds upon the death of the insured, the amount exceeding the policy's ACB is credited to the CDA. So what that means is, number one, the policy has to be owned by the corporation or holdco. The opco or holdco also has to be the beneficiary. And when the life insured passes away, that's when the calculation is done to calculate how much CDA balances there now is in that corporation to allow for a tax-free capital dividend to be distributed. So to give you an actual example, so say someone had a $2 million life insurance policy. This is owned by the corporation. The corporation is also the beneficiary, and this the life insured, say, passed away. So first and foremost, the $2 million would get paid tax-free to that corporation or to that holdco. But at the same time, there's also going to be a credit towards this corporation's capital dividend account. Now, if this life insured lived to life expectancy and it was a whole life policy, so let's assume they lived to mid 80s, the credit would be for the full $2 million. One thing not to get caught in as an advisor is if someone buys a whole life policy and say it's for that $2 million, they're 50 years old, and they say, if I die next year, can the full $2 million come out? The answer is no. So back to the definition, it's over and above the ACB. So in the early years of the policy, and even it could be for decades, there is going to be an ACB, so therefore the full 2 million will not come out tax-free. A pretty good chunk of it will, but as the years go on, more of it will be eligible to come out tax-free based on the formula. So you really have to let them know that if they live the life expectancy, then yes, the full amount should be credited to the CDA. But if not, then 1.5, 1.6, 1.7, 1.8, etc., would come out tax-free depending on the year they pass. With term insurance, it's different. There's essentially no ACB, so the full amount would come out. So this is only applicable to, well, in this example, I'm using a whole life policy. So there is an ACB to that. Now, with this credit, it leaves for a few different planning scenarios. So if a family, say the family of a business owner passes away, they may need the full 2 million out of the corporation. So if that's the case, they pay a $2 million tax-free capital dividend out of the corporation, and now they have the proceeds in their personal bank account, and that's perfectly fine. And they've used the entire CDA credit. There is one extra level of planning that may be applicable to the family. So if they have other shareholders, they could be family members or even future generations who may or may not even be shareholders at the time. If this corporation or holdco had other assets in it, they may prefer to take those assets out of the CDA credit, keep the life insurance death benefit in the corp, and then slowly pay that out through the CDA balance over a certain amount of years. So you don't have to use it in that year. They could keep the 2 million in there. They could pay $200,000 a year for the next 10 years if they wanted to. They could do 500,000 for 4 years. They essentially get to use that CDA credit any which way they like. But sometimes there's alternative assets they may want to use through the CDA and not specifically the life insurance proceeds. So it just adds a layer of planning opportunity for the family themselves. Now, taking this one step further, if someone had that $2 million life insurance policy and say they borrowed against it during their lifetime, let's say they borrowed $1 million, and whether that includes how much capital they've actually borrowed plus the interest on it. If this individual now passed away, 1 million would get paid tax-free to the corporation because, as you know, the life insurance company will deduct the million or whatever has been borrowed from the actual death benefit. But the interesting planning thing is the CDA credit is still for the total life insurance paid out, again, assuming the individual lives to life expectancy. But the CDA credit isn't affected by whether or not the individual borrowed or did not. So if this is the case, they're eligible for $2 million to come out, but they only got paid $1 million from the life insurance policy. So because they're eligible for 2 million, the 1 million can come out tax-free, but they also have another $1 million of CDA credit that they could pull an additional $1 million of, say they had profit sitting there or cash. So assuming just a 50% tax bracket, I mean, that would save them $500,000 in taxes, because if you take $1 million out of the corp any other way, dividends or salary, you're basically paying 50% tax on average. So some owners will borrow against the policy during their lifetime, use that money back to the business or for investments or whatever. But the key thing to note is the CDA credit doesn't factor in the how much they're borrowing. So it could be for the full amount. Now, as far as client goals or applicable clients that may deal with the CDA, first of all, it's anyone with a corporation or holding company. This does not have to apply just to wealthy families. Someone may find $100,000 CDA credit very valuable to them based on their situation. So I wouldn't count anybody out. This is a great way to educate a client that isn't just about life insurance, but shows your holistic financial planning. So to talk about this with literally anyone that has a holding company or corporation is going to set you apart from the rest of advisors. It's also for those that are looking at future corporate planning. So if they do want to redeem assets out of the corporation or holdco tax efficiently and tax-free, of course. Now for the business owner, they would, this has to be with after they've passed away. So it's not necessarily something they can do during their lifetime with the life insurance, but it can be for the other ways you can credit a CDA, such as the non-taxable portion of cap gains. But for the life insurance specifically, the life insured does have to pass away. But it still is very important to do as far as future corporate planning and then, of course, estate planning as well. Anybody with any sort of sizable assets within the corporation or holdco, getting a CDA credit when they pass, when you show them the math, is going to be incredibly helpful from a tax savings and efficiency standpoint for their estate planning. Weston, I'll stop sharing and you can pop it up.
I'll jump over onto mine. Thanks, Mike. Very good. Okay. That should be up okay. All right. So as Mike mentioned, oh, I guess is mine not showing there yet?
Yep, it's
I
showing the
can, I
screen.
can see it.
Okay, sorry. Um, so the CDA can play a very big role, especially as we get into um, corporate planning, as Mike mentioned. So I'm going to be talking about buy-sell agreements with insurance, and the opportunity that come around behind them, and to be able to properly present this to a client as well. As Mike talked about, having knowledge of the CDA can set you apart. Here's another aspect of planning and knowledge, that if you can talk intelligently about buy-sell agreements, it'll definitely set you apart from a lot of other advisors in the marketplace. So what's the importance of a buy-sell agreement? These are essentially set up between inside of a business or between business owners to facilitate a number of different things, but any scenario where there might be a reason to purchase a business or to sell it between partners. And first of all, it ensures smooth ownership. In the case of significant events that are not planned, death, disability, maybe a retirement that's a forced retirement due to a disability or something like that. Helps prevent disputes because it clearly outlines what that transition and that buy sell is supposed to look like. Protecting business continuity. Obviously, we want to make sure that things continue as smoothly as possible. And not get kind of hung up with getting into arguments about how the agreement should be enacted and transitioned. Defines valuation methods. Another important one here. If people aren't on the same page as to what the business is worth or how you're going to determine that can create a lot of disputes. Here's a big one. Restrict undesirable owners. And this really comes down to a situation where most business owners, you have a partner or something like that. Although you might enjoy working with the partner, you probably don't want to be working with their spouse or their kids in the future, especially if it's just because of an unexpected death or disability or something like that. So to avoid that kind of situation, buy sells are extremely important. Um, Provides the funding strategies, and this is really where the insurance comes in. And we'll talk about what some of the different strategies are and why or why not you want to use insurance. Mitigates risk. It ensures fairness because again, you're upfront about how everything's going to be handled, and everybody has agreed to the buy-sell agreement beforehand. So from there, well, how can they go wrong if that's what we're trying to achieve with all those other ones? Where do they go wrong? So there's lots of examples of this you can find online. I'm just going to keep it at a high level. Unclear language, and this is what I find is the easiest one where it gets hung up. Too often, you'll ask a client or something, do you have a buy-sell agreement? So yeah, we do. But once you look at it, what becomes pretty obvious is their lawyer probably doesn't really deal in this, doesn't know a whole lot, and likely had their paralegal just pull a boilerplate buy-sell agreement out of whatever catalog of agreements they have and stick in the client's name and their partner's name and so forth. And they haven't gone through these to any degree to make sure that they're set up properly. So that they're easily understood and can avoid issues in the future if and when they're needed. Improper valuation methods, again, depending upon the industry, the business, how long it's been around, stuff like that. There are some valuation methods that aren't appropriate and some that are. So again, we want to make sure that the proper ones are outlined in the agreement. Lack of funding provisions. This is another one where they just say, oh yeah, business owner A passed away, business owner B is going to buy the business, but they haven't, there's no provisions, there's no discussion on how that purchase is going to happen, or what's going to fund that to do so. Failure to update, another big one, is that, yeah, they put a buy sell in place, but it hasn't been looked at in years. And by that point, maybe ownership has changed a couple times. Maybe the business has changed, what it's involved with, what its value is, and so forth. So again, this should be a regular thing on an annual basis, and or when there is any significant changes to the business itself. Ignoring tax implications. This is another very specific one. Is okay, great. You buy the business, but how is that being done? How is that sale being facilitated? What is the structure of it? Because if it's not done properly, the sale price might be, might be a nice sale price, but what is the final number that actually comes back after taxes are accounted for? Inadequate triggering events. They clearly haven't defined what's going to cause that buy sell to get done, and this can cause a lot of disputes. Excluding key stakeholders, which is a major issue if there's a silent partner or somebody who actually is involved in the business should be at the table and they're not. This can cause issues and lawsuits down the road. The flip side of unclear language is overly complex. You get too many lawyers involved, and suddenly they go crazy with the legalese, and nobody really can understand what they're trying to accomplish at the end of the day. Big one for us as insurance is policy not matched to the buy-sell agreement, and in any number of ways this can happen where the death benefit is not properly matched to the valuation of the business. The policy structure doesn't match the payout structure. Ownership, payer, beneficiary designations aren't set up appropriately on the policy. CDA isn't defined in terms of the payout, who it goes to, how it's going to be used. So there's lots of areas there where that can cause problems in a buy-sell agreement. So the most common elements of a buy-sell agreement is a triggering event, and the first three are often well, actually the first two, I should say, the death and disability are usually the two biggest ones for us as that we can help mitigate as insurance. But also retirement, divorce, bankruptcy, other issues like that can cause triggering events. The proper evaluation method, what are they going to use in there, and specify how the buy-sell will be structured and financed. So those are three kind of key elements that really need to be outlined in a good buy-sell agreement. And then what are the benefits of having it properly prepared and set up? Smooth transition for the surviving shareholders. You decrease the decreased or disabled family is taking the deceased or disabled family is taken care of financially, making sure that they're properly provided for, and ensures smooth business continuation. And then finally, it reduces stress for all shareholders and family members of the deceased or disabled because they know that there's a plan in place to help them get through what should already be a difficult time, but that they don't have to worry. Just one more thing they don't have to worry about. So when we look at funding a buy-sell, there are several different options that are typically looked at. First one is taxable investments or a sinking fund. And I'm not going to go super deep in depth into each one of these of why they're not, may or may not be the best one. But the issue with this one is that the business is now taking funds and allocating them to the side and leaving them in an account. Often in this case it might be a GIC or a savings account that's not earning very much, but that's capital that now the business really can't touch if they plan to actually have a sinking fund to buy out a deceased shareholder, for example. The other side of this is that it takes years to build up a sinking fund, and we just don't know the timing of when these things are going to happen. So, a sinking fund, if it's absolutely perfect, could potentially work. It's by no means is the best option to do it from a number of different angles. Borrowing funds from a financial institution. This is another one where, okay, great. The thing is, you may not always be in a position to purchase, especially if you have one of the key partners has passed away. The bank may look at that and go, hey, that person was the driver of the business. They had all the relationships, whatever it is. We're not comfortable lending to the surviving shareholders to do this at this point. So that can derail that portion. You got to start selling off company assets. Again, usually not a great idea when the business might already be in a little bit of a challenging position because of lost shareholders. Taking funds from company earnings, similar idea. The business may not have sufficient earnings to fund this. to fund this type of thing in the time frame that you'd like to have it bought out. A lot of buy sells are structured over 3 to 5 years. So if the company's earnings aren't sufficient to manage that, that creates issues. So the one that we find tends to be the best solution is a life, disability, and or critical illness insurance for a couple of different reasons. So why do we do it with insurance? One, as we talked about, other funding options might not always be available. Depending upon which one you're looking at, the timing just may not work out, or the funds may not be available. Maybe you can't sell assets at the amount that you'd like, and so forth. Most cost-effective solution to fund buy-sell agreement by a long shot, right? If you start borrowing from the bank or selling off equipment, at some point you may not need to purchase that type of equipment back and so forth. Insurance, we can run tables and do the numbers side by side to show that using insurance policies are definitely the most cost-effective solution to funding a buy-sell. It provides the shareholder with a guaranteed market. And this is really important, especially for smaller business owners and so forth. If say you've got a husband that's running the business, he's got a business partner, and he passes away, and now the wife would like to have the surviving business partner buy those shares back, but if that business partner doesn't have the assets or the ability to do that, then they're in a bit of a pickle there. The surviving spouse is not going to be taken care of. The surviving business partner may be in a position where they don't have the funds or the capital to go forward with this, and then that creates its own issues. So the nice thing is it creates a guaranteed market where you're already established who's going to be buying those funds up front, those shares up front, and how it's going to be purchased. Ensures the money is available when needed, which is, as we just talked about, very important. Provides peace of mind knowing that there's a plan in place. Again, this is, at the end of the day, what a lot of insurance comes back to is just making sure that if and when something bad does happen, your loved ones are taken care of, regardless of the situation. And insurance premiums, although they're not deductible in this situation, the benefits are received tax-free. A big part of that, which Mike talked about, was the CDA. So that is very appealing as well. Where the other scenarios, in several situations, the taxes are still, any funds you get can create taxable situations. So when you fund with the life insurance, guaranteed funds when you're funding with the life insurance, guaranteed funds where death is a triggering event. It creates a CDA where the policy is corporately owned. It supports all personal and corporate buy-sell structures. So there's a number of different share buy-sell structures. There's share redemption, crisscross, promissory note. I'm not going to get into all of them today. Again, it would be a conversation that we would have based upon each client and what their specific goals are, and that would help us determine what the right buy-sell structure is, and therefore what the right life insurance structure would be. And where it's a qualifying disability occurs, if it's a cash value life insurance policy, you could also access the cash value of the policy tax-free to support the buy-sell. In that case, if it's a disability that triggers it. So in this case, a cash value life insurance policy can cover two scenarios, both a death or a disability, if there's sufficient cash value built up in the policy. If you're looking to before I move on, portability of coverage if circumstances change. You can transfer ownership in life insurance from different entities. There can be taxable consequences. However, it's still there. That is a possibility that the life insurance can move as needed, depending upon what's happening with the shareholders and the business. So if you're funding now with disability and or critical illness insurance, things to consider is that the guaranteed funds are going to be there when there's a disability and or critical illness is a triggering event. From there, you can purchase or partial purchase can be made in either a lump sum, installment, or combination of the two, depending upon the insurer that you use in the insurance structure. And again, this comes back to a situation of, is it just a straight buyout right away? Here's lump sum, or are you buying the surviving spouse out or the surviving shareholders out over a period of 3 to 5 years? And there's different ways to structure that scenario. The nice thing as well in this is that it's up to the insurance to determine if the critical illness or the disability meets the definition, right? So it takes the subjective portion of this out of the shareholders, and it's really on the insurance company then to say, hey, yes, this is an actual disability and or critical illness, and there's going to be funds to pay for this. If not, then then that doesn't trigger the buy-sell agreement. And again, there is some portability of coverage in certain circumstances with these types of coverages. Where I find, before I kind of move on to the next one on this one, actually I should, return of premiums is also available on these types of policies, which means that if the policy is never used, there is money that can come back to the business owner and or the insured, depending upon how you set it up. And where these ones, the disability, the critical illness comes into play for buy sell, and I don't see many buy sells with them though, is if you have a partner that goes down because of a disability, your business partner, hopefully you like each other and you've been working together for a while and so forth. But you're going to do everything you can for the first 6 months or year or so to make sure that the business is taken care of, and everything you can to help out your partner. However, at some point, a year in, year and a half, 2 years, if you're the surviving or the only business partner that's actually still working in the business, and you're working super hard to try and keep everything going, and the other partner's still just reaping dividends and that kind of stuff without actually contributing to the business because of health reasons, that can get tiresome, and that can create resentment and so forth. So having disability and or critical illness available as a way to buy out that partner that may or may not never come back to the business is not a bad idea, and can really help alleviate that kind of situation. So what to consider when determining if a shareholder agreement is properly structured and funded. So a number of different items here. One, types of shareholders. Are they individual shareholders, sole proprietors, or corporation? The fair market value of the companies and its shares. Is there any outstanding liabilities that are involved with the business? Capital gains on the sale of shares. How is that being handled as far as the buy-sell agreement? Is it set up to do that properly? Capital gains exemptions. Again, is the sale of the shares going to trigger capital gains exemptions or not? And it depends on the structure. Can the dividends flow intercorporately tax-free? Deemed dividends on the repurchase of shares is not considered a sale, but a redemption. So that can affect your capital gains opportunities. Creation and utilization of the capital dividend accounts. Really quickly on that one, there's I believe it's the Daniil case, very well known. It was back in the 90s. I believe it was a Daniil case where they had a life insurance policy. A partner paid out. One of the partners died, but when it came time to pay the surviving spouse, they paid them with straight funds that was not part, and they didn't use the capital dividend account. So that meant that the money that went to the spouse was fully taxable, and the business got to keep the CDA. Now, if you do, that comes down to having a proper buy-sell agreement to say, do we agree to that or not? In most cases, right, you want to make sure, if you're the one that passed away, you want to make sure that your spouse received as much money as possible. Where in the other scenario, they kind of got hooped because they ended up paying top marginal tax bracket on a significant amount of money, and the surviving business owner, was able to then draw whatever they wanted out of the CDA at their leisure. So again, those are things that need to and surely should be discussed before the buy-sell agreement is solidified and put in place. So just to kind of round out, and I know we've covered a lot of ground here, but just examples of policies for, just say a $2 million fair market value business. You got a male and a female, late 40s or 50s. They own an IT business together, and they own it 50-50. Some of the opportunities, right? The very low-hanging fruit in this case would just be a term policy, very, very inexpensive for $1 million on each of them. you're only looking at about $800 a year. The thing in this particular case, though, is that, as Mike had mentioned before, it does create a full CDA. So if either one of them was to pass away, $1 million would go into the company, and it would create a full $1 million CDA for that business at that point to then facilitate a buy-sell agreement. These are all often also more useful as well if there is cases where there is liabilities in the business, where they have loans or outstanding debts and stuff like that. A term policy is often a good solution, and a lot of accountants actually like the idea of having life insurance in place to protect the business when there is loans and debt outstanding. In this case, if you wanted a permanent solution with some more flexibility, cash value, and that kind of stuff, a pretty basic whole life insurance policy would be somewhere in the area of $12,000 a person. In this case, but again, there's lots of benefits to having that cash value be building up, flexibility of ownership, and things along that kind of line. And again, this would be portable if and when needed to be. Disability coverage using a 1.5 year waiting period for a male or female to cover up to $1 million. $5,500 or $8,200. So what is that? About $14,000 total in that case, and or a critical illness policy with a return of premium on death would be in the 18 to 21. Now the thing that a lot of people may look at when it comes to disability and critical illness, and I know a lot of advisors don't work with this, say, well, those are expensive. They can be expensive, and maybe we just go with the term life insurance policy. Well, the reason that these are what they cost what they are, is because guess what? People claim on them far more often than the term policy. So while they may think, yeah, I'm good with just the term 10, the fact of the matter is that well over 90% of term policies never get paid out. It is the whole life, the disability, and the critical illness policies that are what need to be in place if and when something goes wrong, because they're the ones that happen more and more frequent, most often than an early death. So that's often the conversation I have with clients, is understanding what the actual risk is to having a disability or a critical illness versus having passing away in the next 10 years in that scenario. So from who are the prospective clients? Closely held businesses, and any business with a small number of shareholders or partners really should have a buy-sell agreement. Family-owned businesses, for sure. You have kids, that they fight. What's going to happen when you're not around. So a buy-sell agreement among family-owned businesses are exceptionally important. If there's partnerships, again, those should be defined. Those can often be outside of a corporation, just straight individuals, but important to have those in place. Small business owners, any small business owner who wants to protect their business and ensure its continuity. Professional practices are another big one. If you have doctors, lawyers, accountants who share ownership in a practice, very important that they have a proper buy-sell in place as well. And businesses with key employees. Here's another one that's often underserved. Is I've seen a lot of trades businesses, for example, where the employees end up buying into the business and so forth over time, and that's how the business owner, they transition into retirement, and the employees take over ownership. So again, having proper buy-sell agreements in place for those folks is very important, and obviously having those properly funded is key. So client goals, just to wrap up: ensure business continuity, helps to prevent disputes. They want to make sure that their business is properly valued. They want to make sure that the remaining owners are properly protected. It provides financial security for the deceased or the disabled spouse or heirs. You plan for future events and maintain control, right? In some cases, a key business owner passes away. If there's not the funds there, predatory competitors or other businesses can swoop in and pick up the business at a song, or they just sit on the side and say, hey, we'll wait till the business crashes and we'll just pick up the assets for a penny on the dollar. So this can really help to make sure that the businesses are able to continue on and make sure everybody's made whole at the end of the day. How do you start the conversation? You ask the client if they have a buy-sell agreement in place. You'd be amazed at how many do not know or don't have one at all. If they do have it, great. When was it last updated? Do they know how it is funded? Again, very few actually know either one of those. And the last thing is, can you share a copy for review as a value-added service? You just, hey, can we take a look at it for you and just make sure that it's worded properly? We've seen issues with them in the past. And that gives us an opportunity to look at what they have and see all those things we listed before of where they go wrong. Can we address those for them and add some value to make sure that they're properly protected, which is really, at the end of the day, our goal is to make sure our clients are as best protected as we're able to do for them. So that'll be the end of it. I know I covered a lot there. Corey, you want to take from there? I need to drink water. A lot of talking there.
Yeah, thanks, Weston. I'm sure you need a break after that. That was a lot of information and a lot of really good information. So I do really appreciate you going through that topic, and Michael as well with the CDA account. If you have any questions, Weston, Michael, and myself are available. If you have clients that this might be a worthwhile conversation, or if you want to kind of talk through an example or prospect that you have in your sort of network that you want to talk to us about, we have 3 great resources here for you to help kind of understand these strategies and how it actually relates to each client, because every client's unique. They have different structures, they have different goals, they have different wants, needs. So it is always a unique exercise to go through these. And I would also remind any of my advisors or the advisors on this call that are in partnerships, that have their own corporations, that have multiple shareholders, you need to do this for yourself too. I know of some teams that are pretty large and successful, and multiple advisors that are working full-time hours or sometimes more. And if something happened to one of them, it would be a pretty major impact to the business, and they may or may not have buy-sell agreements in place. They may or may not have them funded. So also look internally if you want to talk to somebody about that and your own team structure. I'm happy to help on those cases. I have been through that with quite a few advisor teams as well, kind of understanding kind of what happens when you are selling your book, and if you're selling it to your partner, and then potentially needing to add other team members. Because you got to think, if you have 2 people working sort of 40 hours or more a week, and one of them gets disabled or passes away, the other person, are they going to work 80 to 100 hours, or are they going to have to bring in somebody else? And then how does that work where they get the funding, because now they have to pay out their partner for their portion of the ownership. So it's important to have these conversations, and I'm here to support if anybody needs me. Last week, we covered the PAR as an asset class, a very important topic that loops into a lot of our corporate strategies. And the next one we'll be doing is March 11th. Corporate Insurance Strategies 2 will cover health spending, executive health spending plans, and wage loss replacement plans. Again, 2 topics that are not covered enough with clients. There's a big gap in the marketplace there. We are taking a break because, as I understand, it's RSP season. A lot of advisors are busy, and some clients are still last minute RSP clients. So that's why we're taking a break for a few weeks and wait until March 11th. So thank you everybody for joining us, and thank you Michael and Weston for presenting today. Really appreciate it.
Take care.